resume the recording. There we go. Hey, James. I told him you were worth the wait.
Okay, awesome. Sorry about that. I apologize for being late, everyone.
That's not a problem. I just wanted to real quick tell everyone that we will have a brief kind of poll at the end of this webinar. We're starting those. That will be part of our process for making sure that attendees get continuing education credits. We're going to be incorporating polls and questions into our webinars so that there's that interactive component to the presentations too. But with that said, I am going to turn everything over to James. James, I'll be monitoring the chat for questions. So if you prefer to have them at the end or interrupt as you go, you let me know.
Yeah, let's take them as they come. Thank you. And then you're doing
wonderful.
The polls at the end, correct?
Yes, that will be the very end. And this is our first time WebEx runs it for us. So hopefully WebEx does it right. Here we go. And I'm going to mute myself and I'll be monitoring the chat. Thanks, everyone.
Okay, perfect. Thank you. Hi, everyone. My name is James Sink. I am the Regional Flood Insurance Liaison for FEMA Region 5. And thank you, Erin and Illinois DNR for putting on this webinar. We're going to talk today about flood insurance. We're going to just kind of discuss the most basic parts of flood insurance through the National Flood Insurance Program. FEMA Region 5 consists of the six states that touch the Great Lakes. That would be Minnesota, Wisconsin, Indiana, Illinois, Michigan, and Ohio. So any questions about flood insurance in those 6 states that Erin or Marilyn can't answer, please feel free to send them to me. You will have my contact information at the end of the slide deck. So the National Flood Insurance Program was created in 1968 to reduce the loss of life and property caused by the nation's most common and costly natural disaster, that being flooding. Interestingly, the same law that created the National Flood Insurance Program also created the National Crime Insurance Program and the National Riot Insurance Program. Guess which one of those 3 programs still exist? The National Flood Insurance Program. It's often described as a 3-legged stool consisting of floodplain management, flood insurance, and risk map. Risk map would be the process that creates the flood insurance rate maps that you are all familiar with. You might sometimes see this described as a 4-legged stool, with the 4th leg being grants. There may be grants available through our Hazard Mitigation Assistance Program to help mitigate flood losses that might be occurring in your community. So the first thing I like to do is talk about the difference between flood insurance and disaster assistance. It's very common that I will be going to a community, talking with local officials, talking with property owners, and the first thing that I will hear from people is, well, why should I have flood insurance if FEMA will just give me a check? That is not always true, and more often than not, disaster assistance is not available. And we're going to talk a little bit more about that in the next couple of slides here. But before we do that, we do have a bit of a challenge across all 6 states in this region. Ever since 2012, flood insurance policies and the flood insurance coverage has been declining across the region. And Illinois is no different than the other 6 states. Flood insurance policies have continued to decline. There are a number of reasons for this that we can talk about if you would like. But the point of this is that people are vastly underinsured when it comes to, again, the nation's most common and costly natural disaster. In most cases, disaster assistance through FEMA is not an option. So without flood insurance, people are left on their own to recover or to rely on friends, family, or local voluntary agencies. If we look specifically at each state, you'll see that Minnesota has the fewest flood insurance policies in the region, while Illinois does have the most, over 33,000 flood insurance policies. However, that does mean that across the state, less than 0.5% of structures are protected by flooding or protected from flooding by flood insurance. Now, here is kind of what I was mentioning earlier. It is a summary of various disaster declarations across the region over the past 10 years, for which flooding was one of the causes of that disaster declaration. And what you will see is that in every case, flood insurance paid out more than disaster assistance. That small green bar that you see, that's disaster assistance. The larger blue bar, that is flood insurance. And in every case, you'll see on average flood insurance is paid out about 10 times more than disaster assistance. If you look at the third disaster in, so that would be 4477 DR, Wisconsin, you'll see there is no green bar. That means for that disaster, there was no FEMA assistance available for individual homeowners and renters. The only FEMA assistance available was to reimburse local jurisdictions and the state government for their expenses related to that flood event. Without flood insurance in that disaster, there was no FEMA assistance available for individual homeowners and renters. So why is this? Well, disaster assistance is not a substitute for insurance. In order to receive disaster assistance from FEMA, there does have to be a major disaster declaration under the Stafford Act. Very few flood events actually receive that major disaster declaration. If they do, most disaster declarations are for what is called public assistance. That is kind of what I was using, that Wisconsin disaster we just talked about. That's an example of a public assistance only declaration. Disaster assistance is only available to state government and the local community to reimburse their expenses related to whatever caused that disaster declaration. Very few disasters actually receive individual assistance. That is when FEMA is able to offer assistance directly to homeowners and renters for damage to their primary residence. And again, disaster assistance is not a substitute for insurance. So for that same reason, disaster assistance, if it's available, only your primary residence is eligible. Secondary homes, vacation homes, investment properties, and businesses are not eligible for disaster assistance through FEMA. Additional disaster assistance may be available through the Small Business Administration. As a matter of fact, in most cases, when people do get disaster assistance for their primary residence, it is actually in the form of a loan through the Small Business Administration that has to be paid back. Every year, the total amount of disaster assistance is adjusted for inflation. This year, it's about $42,000 for home repair and home replacement, and an additional $42,000 for what's called other needs assistance. That's going to be for things like personal property, maybe your car, if all of your vehicles were damaged in that flood event. It could be for disaster assistance that falls in, or unemployment assistance that falls into that other needs assistance category. And finally, again, like I've said, disaster assistance is not a substitute for insurance. Because of that, disaster assistance through FEMA will only make your home safe, sanitary, and functional. It is not intended to return your home to its pre-disaster condition. Looking at flood insurance, though, flood insurance does not rely on a major disaster declaration. As long as the definition of flood in the standard flood insurance policy has been met, flood insurance is available. There is no payback requirement for verified losses. Remember, most disaster assistance is a loan that you do have to pay back. FEMA and the National Flood Insurance Program do not cancel policies for repeat losses. However, we do look at loss history when setting your flood insurance premium. The best indicator of a future flood loss is a previous flood loss. Policy limits are fixed by statute. We do know that these policy limits are low, and in order to change these, Congress would need to change the law, and we'll talk about that a little bit later on. But right now, a single-family home can be insured for up to $250,000. Businesses, agricultural structures, houses of worship, multifamily housing, that can be insured for up to $500,000 for the structure. And we'll talk a little bit more about policy limits later on. Remember that flood insurance is intended to return the home to its pre-disaster condition and in some cases build back better. And we'll be talking about that later on as well. Importantly, remember that any homeowner, renter, or business owner in a participating community can purchase flood insurance. There is no requirement to live in a floodplain. There's no requirement to be in a special flood hazard area. None of that has anything to do with your ability to purchase flood insurance. You simply have to own a structure with 2 walls and a roof that is permanently affixed to a foundation in a participating community. Flood zones have nothing to do with your ability to purchase flood insurance. So let's talk about how you would actually purchase flood insurance. And before we do that, we're going to go through a little bit of a fact or fiction here. And I'll just kind of talk through these as we're going through. So the first one is you can't buy flood insurance if your property has flooded before. As we've talked about, loss history doesn't matter when it comes to your ability to purchase flood insurance. However, it does affect your premium. So having a previous flood loss does not prevent you from buying flood insurance. You can buy flood insurance if your property has flooded before. The next one is you cannot buy flood insurance if you live in a high-risk flood zone. That is also false. Anyone in an NFIP participating community can purchase flood insurance. You do not need to live in a high-risk flood zone. Next one, even if my property does flood, it doesn't cost much to recover. The flooding, again, being the nation's most common and costly natural disaster, can really significantly impact a family's financial well-being. For most people, their main investment is their home. 1 inch of water can cause $25,000 of damage. So a little bit of water can go a really long way to significantly impacting a family's financial resiliency. So use the cost of flood tool. There's a link to it on this slide to help you communicate with members of your community about how much flood damage can actually be caused even by a small amount of water. And it helps make the case for flood insurance, especially because disaster assistance is rare. We've talked about this, but it is important. It is one of the most common myths that I hear. You can only buy flood insurance if you live in a floodplain. If you don't take anything else away from today's webinar, take this away. Anyone in an NFIP participating community, regardless of flood zone, can purchase flood insurance. This is the most common myth I hear. So again, anyone in a participating community can purchase flood insurance. They do not need to live in a floodplain. I will repeat this several more times because I hear this all the time, okay? Next one, homeowners insurance typically covers flooding. Most homeowners policies, most renters policies, and most business policies do not cover flooding. In most cases, homeowners, renters, and business owners would need to have an additional policy to cover specifically flood perils. And then these next two we've talked about, flood insurance is only available to homeowners. That is not true. Anyone in a participating community that owns a building that has 2 walls, a roof, and is permanently affixed to a foundation can have flood insurance. And then we've also talked about disaster assistance. Disaster assistance is only intended to make the home safe, sanitary, and functional. Flood insurance, on the other hand, is intended to return the home to its pre-disaster condition, and in some cases, build back better. So speaking of flood zones, there are times when people may be required to have flood insurance. So if someone lives in a special flood, if someone owns a building in a special flood hazard area, and if that building is collateral for any kind of a federally backed loan like a mortgage, then they may have a mandatory flood insurance requirement. So if someone lives in a flood zone starting with an A as in alpha or V as in Victor, they likely have a mandatory flood insurance requirement if they have a federally backed loan that's secured by a building that's in that floodplain. Non-special flood hazard areas, so those are going to be zones that start with anything other than A as an alpha or V as in Victor. Any of those other flood zones, flood insurance is optional. People can have flood insurance. They are not required to have it in most cases. Do remember, though, that lenders can always require whatever insurance is necessary to protect their interests in the collateral. So even if someone is outside of the SFHA, their lender could still require flood insurance, even if the law doesn't require it. They do have that ability. Now remember that the non-special flood hazard areas account for nearly 1/3 of disaster assistance payments and 40% of flood insurance claims. So if you're looking at this at the flood insurance rate map, and you see that area of minimal flood hazard, that's not necessarily true. It's 40% of claims and 30% of disaster assistance payments. What that means is that it's minimal risk. It's less than 1% annual chance risk for the specific type of flooding that we map. So we're not looking at things like poor drainage areas. We're not looking at heavy rainfall. We're looking at riverine or coastal flooding. Just trying to advance the slide here. There we go. Okay, so flood insurance rate maps. We no longer use these for setting flood insurance premiums. These are used as a regulatory compliance tool. They tell you if you have a mandatory purchase requirement. They tell you if you have to meet certain requirements in related to your floodplain management regulation at the local level. But these do not have anything to do with flood insurance premiums anymore. And we're going to be talking about that a little bit later on. But again, the important thing to remember here is that anyone can have flood insurance, even if they're not in that special flood hazard area. And you can tell there's a theme here. This is a problem. Remember, anyone in that community. So looking at this map here, you'll see starting on the left, there is that red hashed area. That's the floodway. Depending on the state, you might have additional restrictions when it comes to building in the floodway. That kind of teal colored area next to that, that is special flood hazard area, zone AE. 1% annual chance floodplain. Your local floodplain management regulations would apply. The burnt orange color, we call that shaded X, even though it's kind of more of that kind of burnt orange color. It's a holdover from when we had paper maps. That is the 500-year floodplain or the 0.2% annual chance floodplain. Flood insurance is available. It is likely not required, but of course, lenders can always require whatever insurance they feel is necessary. And depending on the community, you may or may not have floodplain management requirements for that shaded X area. Where you see those little islands where there's no coloring whatsoever, that's going to be a zone X, area of minimal flood hazard, again, for the specific type of flood hazard that we map. Flood insurance is available, likely not required. We can come back to this video, time permitting. It does introduce the new pricing methodology. You might hear that called Risk Rating 2.0. It is the current pricing methodology. We've been using this for about 3 years now. The legacy pricing methodology, the thing that we were doing for 50 years where there are rate tables and where we're looking at the flood maps and the zones, and that doesn't exist, and it hasn't existed for about 3 years now. We're fully onto this model based Risk Rating 2.0 system. So at a high level, when we're setting premiums under Risk Rating 2.0, these are the 3 things we're looking at. We're looking at where the structure is located, how the structure is built, and then what is covered and how much is covered. And I think that a lot of these things are intuitive and kind of self-explanatory. So when we're looking at where the structure is built, we know that there are some parts of the country that are higher risk than others. So let's say you have a building in an AE zone along the Mississippi River here in Illinois, and you have an identical building on a barrier island down in Florida. You know, in the legacy system, if they were both in zone AE and the elevations were the same, they were paying an identical premium. But you and I both know that the flood risk is fundamentally different. We don't get storm surge here. We don't get hurricanes, you know, so why should the premium be the same? The new pricing methodology helps us recognize that there are geographic variations in flood risk. We might have a building in zone AE here along the Mississippi. We might have a building in zone AE down in Florida on a barrier island. They might have the same elevation, but the risk is fundamentally different. So the premium will be higher for that building in zone AE on a barrier island down in Florida. And I think that that's something we can all understand. We look at local relative elevation. How high is that building compared to its surrounding elevation? How far is it from the nearest flooding source? Higher standards like setback requirements, like building on post piles and piers in AE zones adjacent to V zones. Those all make a difference and all result in lower premiums. But this does mean that as floodplain managers, we have to think about flood risk differently. We're used to thinking about flood risk in terms of vertical distance. We're used to thinking about it in terms of height relative to base flood elevation. And that still is important and that still matters in terms of floodplain management compliance. But when it comes to flood insurance premiums, we not only have to worry about the vertical distance, but we also have to worry about the horizontal distance in a way that we didn't under the legacy system. So if you can think about doing things that are higher standards, that are optional under your local floodplain management regulations, I would really encourage you to do that. It will make a difference for your residents in terms of their flood insurance costs. We look at how the structure is built. Occupancy matters. Foundation type matters. slab on grade or basement, they are higher risk than a building that's elevated on a crawl space. And the lowest risk structure is elevated on post piles and piers. We look at first floor height, and first floor height is not the same as the lowest, it's not the same as what we're looking at for floodplain management requirements. What we're looking at on the insurance side is how high is that first floor above ground level. And I know that that's a big change, but that's only for the insurance side. On the insurance side, we're looking at first floor height above ground level. We're not looking at anything below ground level. Now for floodplain management, again, your local floodplain management requirements are going to continue to apply. You're going to want to make sure that the lowest floor is above the BFE for any post-storm structures in your community. But on the insurance side, we're looking at things a little bit differently. We're looking at that first floor height. Again, it's first floor above ground level. We do not include basements, enclosures, or crawl spaces. We also look at things like proper flood openings. For the first time in the history of the National Flood Insurance Program, we're able to give discounts for doing things like having proper flood openings, regardless of flood zone. So you could have a building in an X zone that has proper flood openings, and we would give them a mitigation discount. So me, for example, I own a home in an X zone in Downers Grove, Illinois. I have a crawl space. I have proper flood openings. Those are all things that are going to make a difference for me when it comes to my flood insurance premium, and ultimately would result in a more beneficial premium because I am built to a higher standard than would otherwise be required. And then finally, we also look at like what is covered and how much is covered. So we look at the replacement cost value. We look at the total coverage. We look at deductibles. This said, it's not as easy as just going and looking at a rate table and calculating a premium. You can see here how a lot, how additional factors, how all these things are kind of combined together to come up with an individual, unique risk-based premium. Fundamentally different from the legacy system, but this is a high-level summary of what we're looking at. Again, where the structure is located, how it's built, and then what is covered and how much is covered, those three things. So flood insurance offers 4 coverages. Coverage A is the building coverage. Coverage B is personal property or contents. Coverage C is other coverages. And then coverage D is increased cost of compliance. Building coverage and personal property coverage, I think, is self-explanatory. Just remember that they are purchased separately. They are 2 separate premiums. They are 2 separate items on a declaration page. It is possible to have only building coverage. It's possible to have only contents coverage. It's possible to have both. So if someone is a renter, they're obviously going to have only contents coverage because they don't have an insurable interest in the structure. In that case, the landlord would have only building coverage because they probably don't have personal property in that building. They could, but they might not. Probably don't. Okay. Most homeowners, for example, are going to want to have both. Business owners probably want to have both because we will cover their inventory if there's a flood loss. Coverage C. I don't see these getting used as often as we should. We will pay for things like debris removal. Loss avoidance measures will pay up to $1,000 for you to sandbag or put in a pump, or whatever you need to mitigate the risk of imminent flooding. We will pay up to $1,000 to take those loss avoidance measures, and the deductible does not apply. Same thing with property moved to safety. The nice thing about flooding in this region is that we tend to have some advanced notice. Of course, there's always an exception for things like flash flooding or something like that, but usually with riverine flooding, we know that it's coming. And so that makes it so that we can take advantage of things like loss avoidance measures. We can take advantage of moving property to safety. So good example being when the Souris or Mouse River flooded in Minot, North Dakota, I think it was back in 2012, there was plenty of advance notice. And so people were able to move their personal property out of the floodplain and to a safer place. We're able to pay up to $1,000 for that. And again, the deductible does not apply. Finally, here we have the condominium loss assessment. People along Lake Michigan here in Chicago that live in condo buildings often ask me why they need to have flood insurance, because they may be located in an area that's subject to that mandatory purchase requirement. And they'll say something to the effect of, I live on the top floor of this condo building. My unit is never going to flood. Why do I have to have flood insurance? Well, this is the reason. If you live in a condo building, you have a common ownership interest with everyone that lives in that building. So if that building floods, if we enter another cycle of record high levels along Lake Michigan, we could be in another time period where there are waves crashing into the first floor of those condo buildings. And when that happens, your condo association is going to send you a bill for your share of those damages because you have a common ownership interest along with everyone else. If that were to happen, the condominium loss assessment will pay for your share of those flood damages, even if you live on the 30th floor of the building. So that's why you would want a policy, even if you live on the top floor of a condo building, especially along Lake Michigan or the other Great Lakes with the cyclical water levels. And then coverage D, increased cost of compliance. If a structure is substantially damaged by flooding and it's in the special flood hazard area and it has to come into compliance with the current floodplain management regulation or MAP, then up to $30,000 is available to floodproof, relocate, elevate, or demolish the structure, whatever is required by the local community. Julie asks about condos and the homeowners association. This is a difficult question, Julie, because it really is going to depend on the individual and if they have a mortgage. And the reason for that is this. Some lenders will accept like a condo association policy for mandatory purchase purposes, but other lenders won't. Other lenders will want to see the condominium association policy and also an individual dwelling policy because the condo association could be underinsured. And there's really no way for the lender to know whether or not they are as an association, in fact, underinsured. So if you have a loan that's backed by Fannie or Freddie, and your condo association has a condo association policy, you will likely be required to have an individual unit policy in addition to the condo association policy. Other lenders that are not, other lenders might have different requirements. So it really is going to depend on the individual circumstance and who their lender is. My suggestion would be if someone doesn't have that mandatory purchase requirement, I would take a really close look at that condo policy and make sure that there's sufficient coverage, that they're not going to be subject to a co-insurance penalty, and that you're not going to be stuck with a bill if that condo association has some kind of a loss. The residential condominium association policy does get complicated and there's a lot of nuance to it. So if something comes up in your community with the condo association policies, please let me, Aaron, or Marilyn know, and we can answer those case by case, because we do start getting into things like co-insurance penalties with the condo association policies. So they do get a little complicated, but I hope that answered your question. So in general, we are going to cover the building and the foundation. We're going to cover the electrical and plumbing, central air furnaces and water heaters. We will cover the garage at the insurance option. So your declaration page does have to say if you have a detached garage, if we're covering that detached garage. So make sure you're having that conversation with your insurance agent. We will cover debris removal. We talked about that. If you have personal property or contents coverage, we will cover clothing, furniture, and electronic equipment. In general, we cannot cover things like avoidable moisture, mold, and mildew damage. Special limits apply to currencies, precious metals, valuables, and antiques. We do not cover landscaping, temporary or additional living expenses, or decks that are not physically attached to the insured structure. Let's talk a little bit about avoidable mold, moisture, or mildew damage. What do we mean by that? So let's say that there's a flood and you are not able to return home because there's an evacuation order. And because there's an evacuation order, you were not able to get home and start the cleanup process. So now your house is filled with mold. That's not avoidable. There was a local emergency order that prevented you from, taking some mitigation activity and cleaning up the damage, right? Okay, fine. Let's say you're in the hospital. Okay, awesome. We're also not going to hold that against you. But let's just say that your house floods and you don't come back for a year. I've seen this happen. And then you want to have the moisture, mold, and mildew damage covered. We can't do that. If you decide to just not come back for a year, that's avoidable damage. You have a duty under basic insurance principles to mitigate your loss. So in that example, we would not be able to cover the mold, moisture, and mildew damage for the person who just didn't come back for a year. So the National Flood Insurance Program does cover basements, but the coverage is limited. So we're going to watch a short video now explaining basement coverages. And then Aaron, if you just want to let me know if the audio is coming through, I think we should be good, but I just want to make sure. It looks like the video is not going to play. So basically in basements, we're going to pay for the things that are necessary for the building to function. So again, the foundation, we'll pay for electrical, plumbing, all that kind of stuff. We will pay for drywall, but we will not pay to finish drywall. We can't pay for carpet or curtains. If you have personal property in a basement, almost none of that will be covered. The only thing that we would cover in a basement when it comes to personal property, washer, dryer, freezer with the food in it, not a refrigerator. We will not cover refrigerators in basements, but we will cover freezers. For whatever reason, that's what the coverage is. Can't explain it. I don't know. But there's a link to these videos. So Aaron will send you all a copy of the slides when this is done. And there will be a link to the video. You can go ahead and watch that on your own. But it's a good summary of what we cover in basements. And if you have basements in your community and residents want to know what's covered, I would just refer them to the video. It's a good explanation. So we did talk about increased cost of compliance earlier. And again, this is a really important function of your local floodplain management ordinance. Now, as a minimum standard at, the NFIP minimum standard for substantial damage would be 50% of the market value. And so if the building is substantially damaged, again, 50% of the market value or whatever that substantial damage definition is at your local community, if it's more restrictive, and that damage is caused by flooding and the structure is in the floodplain, then up to $30,000 is available to floodproof, relocate, elevate, or demolish the structure as required by the local community. The cool thing about ICC is that it can also be used as cost share for various hazard mitigation assistance programs. So let's say you are in St. Clair County where there was a disaster declaration for flooding last year. And let's say that you are going to participate in the hazard mitigation grant program. There's typically a cost share involved with that. In general, FEMA will pay 75% of the cost, and then the state government or the local government will pay 25% of the cost. Increased cost of compliance can be used for that local portion of the cost share. So this is a really good way for small communities to help meet that cost share for the grant programs that they might be participating in. If your community is interested in doing this, let me know and I will take you through that process. It does require some paperwork on part of the community and on the part of the policyholder, but once that paperwork is done, it's pretty straightforward. There is a special case for group flood insurance policies. Again, this applies particularly in St. Clair County. If people have received disaster assistance and the cause of the damage to their property was flooding, they might be issued something called a group flood insurance policy. A group flood insurance policy offers very limited flood insurance coverage for 3 years following a federally declared disaster for people who are eligible for the group flood insurance policy. FEMA and the National Flood Insurance Program do notify group flood insurance policy certificate holders at least 3 times that their group flood insurance policy is going to expire at the end of that 3-year period. And the reason for that is this. People who have group flood insurance policies have an obtain and maintain requirement. Once that group flood insurance policy expires, they have to go out and purchase a standard flood insurance policy on their own. And that obtain and maintain requirement exists forever. The requirement applies to the address, not to the individual. Okay? So if people who received a group flood insurance policy in St. Clair County last year, so then 2 years from now, that policy will expire, they have to go out and purchase a standard flood insurance policy. If they don't, they will have exceptionally limited eligibility for future disaster assistance. And again, that ties to the address, meaning that if they sell the home and the future owner applies for disaster assistance and they don't have flood insurance, they are also affected by that limited eligibility. And as I mentioned, FEMA and the National Flood Insurance Program do notify GFIP certificate holders multiple times about their obtain and maintain requirement and the fact that their GFIP is going to be expiring. So claims and appeals. Well, first of all, before you can file a claim, you gotta get through your waiting period. In most cases, there is a 30-day waiting period before flood insurance policies come into effect. There are 3 exceptions. The first one is making, increasing, extending, or renewing a loan in the special flood hazard area. So that would, again, be that mandatory purchase requirement. If someone's subject to that mandatory purchase requirement, their flood insurance policy becomes effective immediately when the loan closes. So mortgage, for example, because that's the most common reason, but it could also be a home equity line of credit, whatever is backed by the federal government. If it's in the SFHA and it's federal money behind it and it's a loan of some kind, you're going to have flood insurance. If that's the case, there's no waiting period. There's a 1-day waiting period for map revisions. So if you purchase flood insurance within 13 months of the new map becoming effective and you are newly mapped into the special flood hazard area, then your flood insurance policy becomes effective after a 1-day waiting period. The final one here really it's not really an exception. It's more of a case-by-case kind of waiver that we look at. And it's very rare in this part of the country. It's always possible, but it's rare. And that is the post-wildfire exception. So, and with this one, the stars have to be aligned just right. All of the I's have to be dotted. All the T's have to be crossed, and everything has to be absolutely perfect for this 1-day waiting period to be an option. So the post-wildfire exception is this. If there's a wildfire on federal land, and if there's flooding on federal land, and if that wildfire made flooding worse, and if you were affected by flooding caused by the flooding that was exacerbated by the wildfire, then we can go ahead and waive the 1-day waiting period. So you can see that there's a lot of ifs. There's a lot of things that have to be just perfect with how that works out. I wouldn't be super worried about it in this part of the country. It's definitely more of a concern out west. However, if there were ever any kind of a wildfire on federally owned land in the state of Illinois, I believe that there is a national forest here. So if there were a wildfire in that national forest, for example, I would work very closely with the Illinois Department of Insurance and Illinois Department of Natural Resources to make sure that everyone was aware of the 1-day waiting period for the post-wildfire exception, and then I would make sure that any claims that arose as a result of that were dealt with using that 1-day exception. So not anything to worry about today, but if it does become an issue, I will let y'all know. But yeah, not anything that I think is going to be an issue here. So flood insurance is insurance. And because of that, there is a contract. It's called the Standard Flood Insurance Policy. And in order for us to pay a claim, we do have to have some definitions, right, in order to know if we have an eligible loss. So on your screen, on this slide, are the technical definitions of what a flood is and what a loss has to be. But what I think is most important for all of you to know is that if there's 2 or more properties by inundation of normally dry land, then it's probably a flood and we're probably going to pay the claim. You're not an adjuster. I'm not an adjuster. You're not an insurance agent. I'm not an insurance agent. We're not asking you to make determinations about whether or not it's a flood. If a resident in your community is damaged by something that looks like it might be a flood, just encourage them to file the claim. Let the adjuster determine if this definition has been met. And the worst that's going to happen is that they're going to find out that it wasn't a flood, so just I'm not looking at you all to be technical experts as to whether or not it's a flood. Encourage people to file their claim and let the adjuster make that decision. And the reason for this is that the definition of flood is complicated. It looks really black and white on the slide here, but we have multiple examples from across the region as to how it's not black and white. It's very gray. So if we look at Detroit, for example, There have been multiple basement flooding events in Detroit, all caused by heavy rain. And a lot of times there is sump pump failure or sewer backup or something like that. In every case where there's been this urban flood event, we have paid those sump pump failure and sewer backup claims under flood insurance rather than under their sump pump failure or sewer backup rider, because we are able to make a direct physical link between flooding as defined in the policy and the sewer backup or sump pump failure, and then the flood damage. As long as we can draw that direct physical connection between flooding as defined in the policy and the damage, then there is an eligible loss. So you see why I'm saying I'm not expecting you all to be technical experts on the definition of flood. If someone has some damage from something that looked like it was a flood, just have them file the claim and let the carrier make a decision. So if there's a claim, it works just like any other insurance product. You have to notify your carrier. The individual carrier might have a specific number for you to call. You might be able to just call your agent. It's going to vary from carrier to carrier. But the first thing to do is to report your loss. Let your insurance carrier know that you had flood damage. The next thing that you have to do is go ahead and prepare for your inspection, take photographs. Make sure that if you can, like you're taking photos of like high water marks, make sure that you're gathering the serial and model numbers of any appliances that have been damaged. Work with the adjuster that is assigned to your case. Make sure that your loss is fully documented. And that does mean not only photographs, but receipts, estimates, invoices, canceled checks if people are still writing checks, all that kind of stuff. In order for us to pay something on a claim, you do have to demonstrate that you did have a loss. So and what I mean by that is, what I mean by that is you have to have a receipt, basically, if you want us to pay for something. So sometimes people will try to get us to say that the estimate was low and that their first settlement check wasn't enough. That's fine. You can always come back and ask for more money from your insurance claim, but you do have to provide supporting documentation that you had additional expenses. Okay. If there's a disaster declaration, make sure that you register for disaster assistance. There are some things that disaster assistance can pay for that flood insurance can't. An example being temporary or additional living expenses. We can't pay for you to live somewhere else while your home is being repaired, but disaster assistance may be able to. Again, here's a video on how to file a claim. And I would assume that it's going to have the same issue that the last one did. So we're going to go ahead and just skip that and y'all can check it out on your own time. So let's say someone has a claim and they're not happy with it. Let's say either their claim was closed without payment, or perhaps the claim check that they got was too small. They have a bunch of different options here. The first one is talk to your carrier. Keep working with your adjuster. It might be something really simple, like we are missing a receipt. And if that's the case, great. Get us a copy of the receipt and we'll go ahead and mail you a new check. If you agree on the scope of damages, but you disagree on the value of the damage, then you can have an appraisal, but that is very specific. Again, you agree on the scope, but there's like one specific item where you don't agree on the value. Then there can be an appraisal done. You can also file an appeal directly with FEMA. That appeal does need to be done in writing. And you do need to say specifically which items are in dispute and provide supporting documentation. It's not enough just to say, oh, I don't like how much money I got. You have to actually explain what issues are in contention and provide supporting documentation. And again, that is done in writing. It is done to FEMA. It can be done via postal mail or email. And it has to be filed within 60 days of the initial denial letter from the insurance carrier. Or if all else fails, people can file a lawsuit, but there's a very, very strict 1-year statute of limitations on filing a lawsuit. And it is going to appeals does not reset that statute of limitations. That 1-year statute of limitations for filing a lawsuit starts from the day that that initial denial letter is received. So you have 1 year from the date of that initial denial letter. Going to appeals does not toll the statute of limitations. It has to be filed in federal court, and it has to be filed in the federal district court where the damage occurred. very, very strict litigation rules about the National Flood Insurance Program. There is the Office of the Flood Insurance Advocate for anyone that has a problem with their flood insurance policy or with their claim that they cannot resolve any other way. And I think it's important that we all understand that OFIA, the Office of the Flood Insurance Advocate, is the last step on the problem-solving pathway. So you should be able to resolve any issue with your flood insurance by working with Aaron or Marilyn in Illinois DNR, me here in the regional office, or with the insurance carrier. If after exhausting those options you cannot resolve the problem, then OFIA is the place to go, but they're the last stop. You have to exhaust all of your other options first. In the 5 years that I've been in this role, we have referred someone to OFIA one time. And that is because her circumstance was just incredibly unique and required programmatic changes in other parts of FEMA. So that's why it had to be referred to OFIA, because other parts of FEMA had to update their program in order for her issue to be resolved. So clearly in every case except for that one, we've been able to resolve it either through the Department of Natural Resources or here through the regional office. So NFIP reauthorization. This is something that is kind of a perennial topic. We've been through, I think, 27 short-term authorizations now. Congress has to renew the National Flood Insurance Program no later than 11:59 p.m. Eastern Time on September 30th, 2023. Not anything to worry about now, but just a date to keep in mind. I will let y'all know if anything happens with that. But basically, if Congress fails to reauthorize the National Flood Insurance Programs, it means that we cannot issue any new flood insurance policies and we cannot renew existing flood insurance policies until Congress reauthorizes the program. Don't need to worry about that for a while, but we've been through 27 of these over the past several years, so I think we're pretty used to it. And it's really not been, the program really hasn't been interrupted. We've kind of got this down to a science now, okay? But we'll cross that bridge when we get there, and I'll let you know if there's anything important that comes out of this year's reauthorization package. The other thing is NFIP reform. In May 2022, we submitted 17 legislative proposals to Congress to update the National Flood Insurance Program. That was under the previous Congress, so we just recently resubmitted those proposals to the new Congress. And it would be really helpful in modernizing the National Flood Insurance Program in a variety of ways. It would first of all establish an affordability program for low-income people who might have trouble affording their flood insurance premium. It would allow us to significantly increase our policy limits. It would allow people to purchase higher increased cost of coverage policy limits. We know you can't elevate a house for $30,000 anymore. So we would like Congress to let us offer higher coverage amounts. We would like people to be able to opt in to replacement cost value for loss settlement instead of being required to have actual cash value. We would like to unify repetitive loss and severe repetitive loss definitions across program areas, because right now there are different definitions depending on which program area you're looking at. So it would really help us be more consistent across the National Flood Insurance Program, across all of the FEMA regions, across all of the participating communities. It would resolve a lot of problems we have with equity in the program. And I think it would just really overall help us modernize the National Flood Insurance Program. I cannot give you a specific call to action, but I can say that if you think that these are good ideas, we, FEMA, would appreciate your support on those legislative proposals. The last video here is a nice video just reminding everyone why flood insurance is so important. Earlier on in this presentation, and I'll actually go back here and show you. So this slide here, this is from the first flood event I worked in this region after becoming the regional flood insurance liaison. This is the 2018 floods in Wisconsin. And this gentleman here had a creek or a creek, whatever your preferred regional pronunciation is, that ran through his backyard. That creek or creek was mapped as special flood hazard area, but his house was located in the X zone. He went to his insurance agent, said that he wanted to have flood insurance, but guess what his insurance agent said? You can't have it because you're not in the floodplain, which I hope we've established by now anyone in a participating community can have flood insurance. So these 2018 floods come along, and that tiny little creek or creek in his backyard becomes a raging river. And you can see it went through his house with such force that it pushed the cars out of the garage wall. And there are pictures of the foundation where it's entirely blown out. And I don't have a good ending for this story. All because his insurance agent told him erroneously that he was not eligible to purchase flood insurance. But we can contrast this with the guy in the video at the end here. His name is Marty Severson. He's from Sparta, Wisconsin, and it's that same 2018 flood event. And his outcome is the exact opposite. He is in the X zone. He didn't have to have flood insurance, but he chose to have it. And because of that, his road to recovery following that 2018 flood event was night and day different from that other gentleman who did not have flood insurance. So just a reminder of how important flood insurance is, especially outside of those X zones. So Aaron, I do have some additional resources here. Again, that will be shared with all of you when you get a copy of the slide deck, but I am happy to answer whatever questions y'all might have today.
James, thank you so much. I'm going to say anyone who wants to unmute themselves right now, please go ahead. You should be able to. If you have any problems with that, let me know in the chat and I can unmute you. But thanks again, James. I think we've seen over and over, and even in St. Clair, you know, we were dealing with residents who were told they weren't eligible for flood insurance. And, you know, as people who work in floodplain management and who have that interaction with residents in a community, it's really important that everyone understands the availability of insurance, the different ways that it's figured, and really the importance of being able to get your home back into a livable condition.
Well, and Aaron, I think that we also saw down in St. Clair County the importance of increased cost of compliance. With many of those structures being substantially damaged and needing to undertake some kind of mitigation action. You know, right now, a lot of people are waiting on a grant program, whereas if they had increased cost of compliance, if they had flood insurance, they would already have that money in pocket, and they would, I mean, we're almost a year post-flood right now, and people are still waiting for some addition, for other FEMA programs to become available.
Exactly. Yeah, federal programs can move very slowly at times.
Yep. So mitigation grants can take many years. So just keep that in mind. The grant process is not quick. So if people want to be back on their feet quick, if they want to start recovering quick, the best way to do that, again, is through flood insurance. It's not waiting for a grant program to come in. That's going to take time. Yeah, Lee, when you get a copy of the slides, the cost of flood tool, you can just click right on that in the PDF, and it'll take you directly to that tool.
And we will get those slides out to everyone who provided an email in their registration. If you're just calling in and somehow didn't register with an email, please either shoot your email now or into the chat, or send a message. James put his email in there in the chat. You can email him directly, or you can reach out to Marilyn or myself. And here's Marilyn. Go ahead, Marilyn.
Hey, Marilyn.
So James, I have a question for you.
Sure.
Let's say I have a house, and the house is worth $200,000. So, but I only owe $100,000, and I asked my lender, because I want to reduce my cost of insurance, if I can just insure the loan amount, and they agree. So I am now carrying only 50% coverage. I have a flood. My damages are $20,000. Will my payout be reduced because I did not carry coverage for the full value of the building?
Marilyn, I'm so glad you asked that question, and you kind of heard me allude to it when I was mentioning some of the legislative changes we would like. In that example, that person would likely get significantly less than they might otherwise be expecting. So when we settle a claim, we're going to settle a claim using one of two methods. There are 4 methods, but 90% of times we're looking at one of 2 things. We're looking at either replacement cost value or actual cash value. Replacement cost value is the cost to repair or replace the damaged items without withholding depreciation. So to buy something identical, similar kind and quality, right? Actual cash value is the cost to repair or replace that item minus depreciation. To qualify for replacement cost value, which is what you want, because that's going to get you the most money to recover, it needs to be your primary residence, and you have to be insured to 80% of the replacement cost or the maximum amount of insurance available under the program. So in that example where the house is worth $200,000, but they only have $100,000 in flood insurance, they are going to get actual cash value, meaning that we are going to withhold the depreciation from that claim because they're not insured to 80% of the replacement cost value of their home. So in that $20,000 loss, it might not go very far because they're deductible. They're going to have a deductible withheld, and then the depreciation. So it can eat in pretty substantially. I've seen it eat like 50% of the claim that people were expecting to get, and that is really, really difficult. So it's important to know that you do have to qualify for replacement cost value. Replacement cost value is only for primary residences, and you do have to be insured to 80% of the replacement cost value or the maximum amount of insurance available. So kind of a long answer, but it's a very important question. Thank you, Marilyn.
So when you have a loan, like a homeowner might know, I bought this property, which is the land and the house, for $200,000, and I owe $100,000. But the replacement cost value, is that something that you then discuss with the insurance agent, and they tell you, okay, yeah, you bought this house for this much, but your replacement cost for the building is that a discussion that happens?
It is. So for single family homes, FEMA will provide the replacement cost value for that insurance agent when that person goes to purchase flood insurance. We have a calculator that uses the square footage of the home, the year of construction, and a couple other factors to establish the replacement cost value of that single family home. So you and your insurance agent can have that conversation. Your insurance agent will calculate it for you. If you disagree, we can look at some other things to get that replacement cost value, but generally speaking, your insurance agent and FEMA will provide that for you. For anything other than a single family home, your insurance agent has to figure out the replacement value. They have to provide that replacement cost value using their usual business practice. So it could be from a different insurance product. It could be from a property valuation. It could be from any number of other things for anything other than a single family home. Single family homes account for 90% of our business though. So for 90% of the people out there, we will provide that for you.
Okay. And last question, because we're over time, but I think I know the one person you referred to, the Office of Insurance Health, whatever you called them.
That was an Indiana case. So.
I thought it was the woman whose insurance didn't get paid by her lender, and so her policy lapsed because her lender didn't. She had a lender-based policy.
Yeah, that still is with underwriting. So as soon as I will follow back up with them, but when I asked them last Friday, they still didn't have an answer for me, but I will ask them again.
Okay.
Yeah, I have a couple of those, and they're all in the same boat where they're all up with underwriting, kind of waiting. I think that this is a larger issue across the nation, so it might be a little bit while they figure out what they're going to do. Yeah.
Okay.
I'm hearing similar situations from regions, so yeah. Okay, thank you everyone. If you have any other questions or anything else that came up, my email address is in the chat box, and then I will get a copy of these slides over to Erin for her to send out to all of you as soon by the end of the day today.
Thank you, James, so much. I appreciate. We know how busy you are. Thanks everyone for coming. Please look to your inboxes. We'll be sending our June newsletter for our quarterly newsletter. Will be coming to you soon. We're going to have any other additional trainings. We're kind of taking a little bit of a slowdown over the summer just because we understand so many of you are so busy with trainings, but we've got lots of good articles in there, and, you know, another way for us to all stay in touch. Again, James, thank you for your time. I appreciate it. Thank you, everyone, for your attendance. Have a great afternoon, and we'll be in touch.
Thanks, everyone.
Bye.